Hey guys, I just want to explain some of the stuff that is in chapter 8 of the 21st Century Accounting Multicolumn Journal by Southwest Cengage Learning. The chapter 8 is on closing entries. A closing entry is a journal entry that's used to prepare temporary accounts for a new fiscal period. A fiscal period is something that a company decides on. It could be a year, it could be 1 month. It's just a period of time where they want to report financial information. So for this purposes, let's say that it is maybe we're closing out entries for the end of the month. So we have our worksheet. This is our worksheet we prepared in chapter 6. We have our income statement accounts and our balance sheet accounts. Then we have our general journal. Actually, it's the multi-column journal. So we have the general section of our journal, we have the sales credit, and we have the cash section of our journal. Then we have our general ledger accounts. So this is where we posted in chapter, I'm pretty sure it might have been chapter 4. We posted these. So as we journalize our transactions, the second step is to post in the general ledger. First journalize, then post to the general ledger. This is where we can look back, and I can look back at this and say, okay, my cash balance is $4,900. From this paper, that matches $4,900. Same thing with the next one is petty cash. We can look back and say, okay, my general ledger account was $75. Okay, my petty cash was $75. The general ledger is where this information is pulled from. Because again, we journalize first, we post to our general ledger, then we put it on a worksheet so we can see everything at once and we don't have to search through our general ledger accounts to try and find our balance for each account. If we don't do this, we won't be able to know how much cash do we actually have. How much cash do we have recorded in our books? So this helps with finding those amounts, and then they're posted on here. But let's go back a little bit. What I was saying about the general or the closing entries. So if I mess up some of my words, I'm just going to restate them instead of starting over the video. So just stick with me. Let's go back to the closing entries. So again, we have to close some accounts out, and those accounts include the revenue, expenses, owner's drawing. Those are the first ones. Then we close out income summary and we transfer everything to the owner's capital. Might sound like a lot, but we'll work through it step by step. So again, closing entries are those journals entries used to prepare temporary accounts for a new fiscal period. Here we have the sales and the expenses. We don't want to record in our new fiscal period that we made, like let's say this is for April. Well, in April we made $2,160. So we want to close all that out to our owner's capital rather than continue on into May. I think that's up for April. We want to close it out so that in May we can see, okay, how much money did we make in May and how much money did we make in April, or how much money did we make in February? If we continue putting money into this and into this specific account here, we're not going to be able to recognize how much money we actually made in April because we just keep putting things into this account. So we need to close it before we move on to the next fiscal period, which again could be by month or could be by year. So we have to reduce balances to 0 to prepare them for the next period, but we don't just want to write 0 in because then we lose all that information. So first thing that we do is just journalize some of the closing entries, and all these entries are going to be closed to this account that we've been using called income summary. So let me write it up here, income summary. Income summary is an interesting account because it doesn't have a normal balance. It's based off of your sales and your expenses. So for the first line, I will write the date. The textbook probably had said that it was April 30th, but let me just look back just in case we have something. So, okay, so a partial worksheet, a partial worksheet of Fix It Now for the month ended April 30th of the current year is given in the working papers. So yeah, we know it's April 30th, so any closing entry is going to be for April 30th. So first thing I'm going to do is write closing entries. We want to be specific here so that we know what's happening in the journal. So I wrote closing entries up at the top there. Let me just turn this sideways to make it easier. First one we want to close out is our sales. So we look at our sales account and we see that there is a credit balance of $2,160. So if there's a credit balance of $2,160, how do you think we get rid of that? How do we make that account to zero? Right, we debit it, if you said debit. So we have first the 2,160. I'll show you that down here. Sales, 2,160. Again, that's that normal balance, 2,160. The credit side is that normal balance when we do our little abbreviation after eating dinner, let's read comics. Normal balance of a revenue account. So to close it out, we'll do 2,160 to a credit. Sales now is zero. In accounting, we have to document everything. So that's why we're doing that. We have to document it. Then let's take 2,160 as a credit to the income summary account. Sorry, I was thinking too fast, not over here. 2,160 because we debited it here, oh, little debit, credit. We debited it down here to zero out this balance, and we credited it up here because whenever we have a debit, we always have to have a credit. So let me show you that in the journal. So the date was April 30th. I'm gonna write a little 30 right there, and I'm gonna write sales. And then I'm going to put my $2,160 here as a debit, close it out to my income summary account, credit of 2,160. This is in the general area. We're not messing with sales and we're not messing with cash because this is not a sales credit anymore, it's a debit. Same thing, nothing's happening with cash. So if you can see that, I'll zoom in a little bit more. 30 sales income summary, and we recorded exactly this. Next one we want to do is any of the expenses. So when we have expense, I'm sorry, I can't see that, expense. Normal balance of an expense account is that debit side. So this is the normal balance. If we want to close out anything, let's say it was 100, 200, 400. If we want to get rid of those numbers, we need to put them on the credit side. So we would do 100, 200, 400, and now we're down to zero. That's just a template. That's just an example. But for this one, we have 1, 2, 3, 4, 5, 6 expenses that need to be closed out. We cannot just write the total. We have to write out each one. So to close those out, again, we need to have a credit. So the total income summary closing out is that $14,800. $1,483. So to close out that, we end up debiting the income summary, $1,483. So we have a debit to $1,483 and a credit to the $2,160. So we want to make sure that we now write off all the expenses. So since the expenses is going to be on the credit side, we're going to write off those on the credit side. We can go ahead and write the 30th income summary up top. And standard practice is to write off all the expenses first, then find the number to put here. So, advertising expense, I'm gonna abbreviate that. Cash short and over. Insurance. Miscellaneous expense, supplies expense, and utilities. Now you might be confused, where am I getting these numbers from? Well, I'm getting them from the front page. So, exact order: advertising, cash, insurance, miscellaneous, supplies, and utilities. I'm getting from the exact page. Then I'm gonna pull these numbers over. So I'm gonna make sure I do the opposite. I'm gonna credit. So again, I debited the sales, I did the opposite, then I'm gonna do the opposite of this. So, first one I get is a credit. I'm gonna leave this line blank to come back to it. $466, I think, for cash short and over. $125 for the insurance expense. For miscellaneous expense, I have $189. Supplies expense, I have $153. And utilities expense, I have $550. So I double checked to make sure I properly put these numbers in by adding them together. So on my calculator, I add each one, and I end up getting the $1,483. So in my income summary accounts, I have a credit of the $2,160. I have a debit of the $1,483. My expense account is now zeroed out because I just credited all of the original debits on my book. Same thing here. I just debited the original credits on my book, and I've closed out the sales and expenses to my income summary accounts. It's always going to be done like this because your sales are always going to have to be debited, your expenses are always going to have to be credited. This is standard practice. So I'm going to go ahead and pause right there before I move on to the second part of this problem, which is posting. I will show the posting in, well, actually it's not posting, it's closing out the income summary and capital account. But I'm going to pause and you can click start on the next video to get the rest.